international tax is an area that we've seen a lot of very significant changes in on both sides of the border over the last couple years, particularly with the passing of the Tax Cuts and Jobs Act here 2 years ago. It's an area that we've come to find out as much, it has a very large impact obviously on our community and a lot of the businesses and taxpayers here, but not many people really know a lot about it, and that includes professionals that we work with. And so we thought it would be a good idea to put a panel on so that everybody can learn a little bit about it, about the reporting requirements, just because it's very complicated, it's very technical, and what makes it even worse is the penalties for non-compliance can be very harsh. They can be very expensive. They can be computer assessed, which means that if you file a form wrong or neglect to file a form, the government computer will just assess you a penalty, and that can be a very time-consuming and expensive endeavor to get it abated, even if you have reasonable cause. And so, that being said, I got my notes. I hope everyone's takeaway today is, that you'll have a high-level understanding of what the rules are, what the reporting requirements are, so that you can at least have a conversation with your advisor or your client or whoever to know, and you can ask the questions and figure out what is applicable to you. And if you don't have an advisor, if your advisor doesn't have a lot of expertise in this field, the gentlemen up here with me are certainly willing and able to help. And I'll introduce him now. I'm joined by Francisco Solís Payan of Consultores Tributarios de Negocios. Did I do that okay? A public accounting firm in Juarez. Mr. Solís is a CPA in Mexico with over 40 years of experience in auditing and taxation of both domestic and international businesses. He has consulted in various mergers, spin-offs, and other restructurings, and has participated in transfer pricing reviews and things like that. He has a broad range of industry experience, including maquiladoras, mining, real estate, construction, and agriculture. I'm also joined by Bill Johns, who is one of my partners at Lauterbach Borschow. Bill is a licensed CPA here in the state of Texas. He has a variety of experience, including in automobile dealerships, farming and ranching, restaurants, and of course, his main area of expertise in cross-border businesses. And finally, Josh Schneider. Josh is a shareholder and attorney with Gordon Davis Johnson & Shane, where he's practiced since 2008. His practice focuses on inbound and outbound business transactions, with a particular focus on cross-border issues in Mexico, international tax planning and compliance, complex international structures, contracts, wealth planning for high net worth individuals, estate planning, and a wide range of other domestic and international tax and corporate matters. The order we're going to go in today is Mr. Solís is going to give an overview of Mexican tax law, along with some changes that appear to be coming, particularly concerning a potential new inheritance tax. Bill Johns is going to talk about recent changes to U.S. tax law with a particular focus on repatriation taxes, GILTI tax, and the foreign-derived intangible income deduction, along with the associated reporting requirements. And Josh is going to speak to business planning and structure issues and how they interact with all these changes. And then we'll leave about 15 to 20 minutes for a question and wrap up. So I'm going to turn it over to Francisco, and he'll start us off.
Good afternoon, everyone. It's my great pleasure to participate in this panel and share with you the most relevant issues regarding with the Mexican income tax law and the cross-border transactions. And of course, joining in this panel with these three gentlemen. Tax in Mexico. Mexico has a federal, state, and local taxes, but Mexico, the main system is federal. So we have only, for example, income tax, federal. We don't have a state, of course, we don't have local. The main taxes in Mexico's are the income tax and the value-added tax. As I said, I will talk with you and share with you the most relevant issues regarding with the cross-border transactions. But who are subject to the taxes? This is very important, and it's very important here in the border, because we have here in the border Mexican nationals living in the United States, but of course U.S. nationals living in the United States, and sometimes they have both nationality. In Mexico, the Mexican income tax law is not based on the nationality. The Mexicans, we are subject to the Mexican income tax law because we live in Mexico. But we are not subject to pay income taxes, for example, if we live outside Mexico. So that is very important in this region, because here in the border we have, as I said, Mexican residents and Mexican nationals with double nationality living here in El Paso, but having business in Mexico. And that creates a lot of tax liabilities in Mexico that these individuals or the companies are subject to pay taxes. But who are they? According with the Mexican income tax law, the subject to pay income tax are the residents in Mexico on the worldwide income, the foreign residents with permanent establishment in Mexico in regards with the attributable income attributable to the permanent establishment. Foreign residents in regards to the income from Mexican sources. Later on we will talk about this. This is a very important issue. One of the most important things, as I said, is the residence jurisdiction. In the case of the companies, a company incorporated in Mexico, but having the main management in Mexico, is a Mexican resident. It doesn't matter if the owners are not Mexican residents, but if the company has the management in Mexico, all the main decisions are in Mexico, are doing business in Mexico, that company is a Mexican resident. The typical forms of companies in Mexico, we have a lot of companies in our corporate law, but the most used companies are the Sociedad Anónima de Capital Variable, which is known as SA of CD. Sociedad de Responsabilidad Limitada is RL of CD, which is known as Limited Liability Company. These two companies are the most used companies in Mexico. And then, in the case of the individuals are residents in Mexico when they have a permanent home in Mexico. But here in the border, probably some have home in Mexico, but home in El Paso, because that is the way what we have here in the border. So in that case, the law, and according with the treaty between Mexico and the United States, in that case, if the individual does not have a permanent home in Mexico, is not a Mexican resident. But if this individual have a permanent home in Mexico and then in the United States, then in order to clarify that and where is the country in which this individual needs to declare. And according with our law and according also with the tax treaty between Mexico and the United States, the law provide a test. If the test is the center of life or the vital interest that that individual has. And according with the law, the center of life or vital interest is if more 50% of the income of that individual is coming from Mexican sources, then in that case, you Mexican resident. For example, if a people living here in Juarez, but having home also in I'm sorry, I'm from Juarez. Here from El Paso, but living in, having another home in Juarez, then in that case has two homes, and probably permanent home because lives there and lives here. But also have business there and have business here. If the income, in that case, is more than 50% of the whole income of this individual in Mexico, then in that case it's a Mexican resident. And that is very important because sometimes individuals having, for example, land or buildings, sold that building, that land, and there's a huge amount of money. And probably that huge amount of money is more than 50% of the income in some cases. In that case, it's a Mexican resident. And what means if it's a Mexican resident? Means that this individual need to declare in Mexico including the worldwide income, including the income received here in the States, plus in Mexico, and then in another country. So that is why it's very important that the residents here in El Paso or residents in Juarez define exactly which is the residence. Because, for example, in the U.S., the tax law states that it doesn't matter for individuals where is the residence of that individual. Needs to declare here in the United States because it's a U.S. national. In Mexico, we don't have that requirement. But if any individual declaring here in the state because it's a national of the United States, but having business in Mexico, resident in Mexico, also need to declare in Mexico. And then paid income tax in Mexico, probably. So that is very important to define where is your home, your permanent home. And the other thing is when you use a lot of Mexicans, they have a Mexican tax ID number, which is known Registro Federal de Contribuyentes. When they go to do any business in Mexico and provide that tax ID number, immediately that transactions go to the tax authorities by the system the tax authorities has. But if that individual is not declaring because he's a U.S. resident or U.S. national, then and is not declaring in Mexico, then in that case the tax authorities, because it's a Mexican national, can request a tax return, and not only by the transaction doing in Mexico. They will request all the transaction in Mexico plus U.S. and another country, because in that case it's a Mexican resident, and then the Mexican residents need to declare on the worldwide income. So that is very important, the residents here in the border. It's not, I was telling Josh, it's not the same a Mexican living in Minnesota, because he or she will not cross in the way we cross here in the border every day or many times a day. It depends on the situation of the individuals. But in the case of the residents, and then in the case of the Mexican nationals, even if they have a double nationality, they need to define exactly where is your residence for tax purposes. In the case of the companies are subject to pay the income tax. I will say it very easy, but it's not in this way. Computing the taxable income revenues less deductions allowable, then is your taxable income. Sometimes your deductions are higher than the revenues. In that case, it's a tax law. In Mexico, we can take the deduction of that tax law for 10 years, and and the amount of the tax law can be updated by inflation. We don't have in the law loss carryback in Mexico. And here is another thing for the companies and individuals, having employees. In Mexico, we have mandatory that the companies and individuals having employees need to pay employees profit sharing. This means 10% of your profits, your taxable profits, goes to the employees. And this is like a tax, but you have to pay this to the employees, and then it's if the companies pay 30% of income tax plus 10% on the employees' profit sharing, then the companies are paying 40% at the end. So here is very important because it's not classified as a tax, but finally it's a tax. What happened with the foreign residents having or receiving income from Mexican sources? And here is again very important, who are resident in the United States but having income from Mexican sources. And then I have, for example, typical examples here on the border. One is the salaries. You know, everybody knows that we have in Juarez a lot of maquiladoras. People coming from El Paso every day goes to work in Juarez. U.S. residents, not only U.S. nationals, U.S. residents. Could be U.S. nationals, could be Mexican residents living, of course, here in El Paso, but working in Juarez. In that case, they are subject to pay income tax, even if they receive the salary payment from a U.S. company, because they are performing the services in Mexico. They are performing the services in a Mexican entity, and then they are subject to pay income tax. And the taxes in that cases, the tax rate is they have exempt around $6,600 US a year. It's exempt. Above that is 15%, and up to $53,000 US, and then above that amount is 30%. That is one of the examples very typical here. Another example is dividends and capital redemptions paid from Mexican companies. In that case, dividends and capital redemptions, we have two levels of taxes. The company is taxing by the law according with the tax rate of 30%. That is the first level. The profits earned in the year are subject to the 30% income tax for the company. But when the company distribute dividends and pay to the owners of that company those profits, then there's another level. The shareholders are not subject to pay the taxes on those dividends, but only if those dividends are already paid income tax. What does it mean? If a year, let me put this example very easy. The company has a profit of $100 and then paid income tax of 30. The net profit is 70. When those 70 is distributed to the shareholders will not pay income tax. That concept, that computation is known in Mexico as a CUFI. So the companies has this computation or that account in order to see how much taxes the company paid in order when the shareholder receive a dividend, then the company is not subject to pay income tax again on those dividends. That's the first level. The second level is when the owners of the company receive the dividends, they are subject to pay the income tax, a withholding income tax of 10%. And this 10% are only for profits coming from the year 2014 and now. So profits from 2013 and back then are not subject to the withholding 10%. And two things finally, and these two typical example is the sale from real property are subject to paid income tax, 25%, and the gross income, or 30% of the net gain, but in this case need to have a legal representative. In the case of the sales of the shares, it's the same, 25% of the gross income, and then but it's possible to pay it on the net gain on 30%. Finally, withholding. This is very important for the non-residents. The non-residents are not obligated to file anything in Mexico. Monthly, annual, to have a tax ID number, they don't have any obligation. This is very important because sometimes non-residents are filing return in Mexico. And then once they file a return in Mexico, they're subject to another obligation. And finally, this is very important also too, the inheritance and gift tax. In 2018, the government proposed to change the law in order to eliminate the exemption that actually we have when an individual receives an inheritance and gift tax. In this case, the tax authorities in that last year, they did not approve it, but they put, we said in Spanish, we put it in el cajón, in the box. So we are waiting, and probably this year they will approve. And the exemption, the amount exempted in the proposal is only 10 million pesos. So here, for example, is more than 11 million US dollars. So in Mexico it's crazy that this proposal, but we believe that will approve it. We don't know exactly, we will continue with these limits, but they will approve it, and then let's see what happens. So, well, this is my participation. The time is end. Thank you very much.
Thank you, Paco, very much. It's important perhaps that we have a little historical backdrop to understand the changes that have taken place as it relates to cross-border transactions and taxation that came about in what I'll just refer to as the Tax Reform Act. And its formal name is the Tax Cuts and Jobs Act. We'll just call it the Tax Reform Act. Previously, the United States cross-border or international tax system was what was typically called a worldwide system, meaning that for individuals, if an individual had income in Japan or United States or in Mexico, and that was a US person, all of that income had to be reported on a US income tax return because of our worldwide system. For corporations, multinational corporations whose headquarters were here in the United States, it was a bit different in that their profits here in the United States certainly were taxed, but if they had profits in a foreign jurisdiction, in a subsidiary corporation, the taxation on those profits were deferred until a dividend was paid from the foreign entity to the US parent. So there was a built-in deferral of the taxation of foreign profits. Now, that structure led to and lent itself to a lot of creative planning, a lot of structures where a lot of profit of multinational corporations whose headquarters were here in the United States were being parked in foreign jurisdictions. Many of them had preferential tax rates and deductions that made it much more beneficial from an economic standpoint for those profits to be in Luxembourg, in France perhaps, in Mexico, or in most other countries compared to the US, due to what at that time was a high corporate tax rate. The Tax Reform Act, though, went after that structure, and now we have what's called a modified territorial system. Now, the reason they went after this loophole, if you want to call it that, or the deferral of recognition of income of foreign corporations by their U.S. corporate shareholders and U.S. individuals to a greater extent, is that there was $2.6 trillion of profits just in the Russell 1000 corporations that were parked or being deferred in foreign jurisdictions as of 2015. That's $2.6 trillion. Now, with that amount of income in foreign jurisdictions, you can see why these structures had a big target on their back when you have a Congress and an administration who were looking to find taxes that would cover other reductions in taxes and deductions that were part of the Tax Reform Act. So it was only natural that companies had foreign entities and that profits were being parked in foreign countries. The Tax Reform Act really represents a revolution with regards to the taxation of profits in foreign entities. Just to give you an idea, we're going to talk about maybe 3 or 4 of the major changes that took place in the Tax Reform Act related to these foreign profits and recognition of that profit. You have to divide in your mind a timeline from January 1, 2018 and going backwards. Okay, so we just start January 1, 2018 and go backwards. And then from that same line on that timeline go forwards from January 1, 2018 into the future. The first tax we're going to talk about is the deemed repatriation tax. Many of you have heard us talk about repatriation tax when we've met with clients and friends related to how the IRS now, according to the law passed by the Congress and signed by the administration, taxed accumulated profits of foreign entities that took place prior to 2018. That timeline we're talking about. Any profits earned by a foreign entity, that entity being owned by a U.S. parent, those profits had to be taxed even though they were not brought here to the United States by way of a dividend. Remember, under the old worldwide system, corporations didn't recognize those profits of their foreign subsidiaries until a dividend was paid. Under the Tax Reform Act, the repatriation tax deemed, or I love that word deemed, you kind of pretend that all those profits were brought here to the United States and then were subject to taxation. This deemed repatriation tax was a significant bad surprise to a lot of taxpayers. The law, as it was negotiated in the House and the Senate, this part was done under wraps. No one knew what was happening related to this particular tax, so they wrote it in such a way that there was no way for attorneys and accountants to react to it in time enough to reduce the tax burden related to repatriation tax. So it was a very sobering time for many of our clients on their 2017 tax returns. The blended rate that corporations were subject to for the repatriation tax was somewhere between 15.5% and 8%, depending on whether those profits were in cash or in other assets. For individuals, the blended rate was between 17.5% and 9%, a blended rate in that range, depending on whether it was cash or other assets that were being parked overseas. The cash, of course, was taxed at the higher rate. Fortunately, we were able to net lost foreign corporations against income foreign corporations. So there was some benefit related to that. And there was an election available to taxpayers here in the United States that they could defer the payment of that tax over 8 years. However, according to the IRS regulations and the Q&A that the IRS released, an election had to be filed with the 2017 tax return in order to qualify for that 8-year installment plan. Now, Josh, when I looked at your notes, you had some comments regarding, well, what do you do if you didn't make that election on time? Why don't you tell us about that?
So this question's come up a lot lately, especially when we have clients come in that want to discuss if they hadn't made the deemed repatriation payments or they hadn't made the election on their returns. Treasury has actually been negotiating with the IRS to try to figure out a solution to this, much I think like the offshore voluntary disclosure programs that we've had in the past. What they've said so far is that they are going to treat this under a reasonable cause standard, which is effectively what we all deal with as practitioners of if you have a reasonable cause for the reason why you didn't make the election or you didn't make the payments, they'll give you a break. My experience with that, and I think Bill's experience with that is if you get to the door before the IRS finds you, they're more apt to take your reasonable cause argument. If they've already gotten to you through an audit, it's probably going to be a lot tougher. My gut is that they may give breaks on penalties related to this, unless they come out with a program. I do not think that they are going to allow us to make retroactive elections, but that doesn't mean that we shouldn't try. I don't think that there's anything to lose by trying to go back and amending 2017 returns to make that election. The worst case scenario is the IRS disallows it. But I think the solution is going to be trying to do that or sitting around waiting for the IRS to come up with some kind of rules to deal with this, because I know it's impacting several clients.
So if by chance you didn't make the election or did not do a repatriation tax calculation on your return, get with your professional and let's figure out a way to come forward and not necessarily do the right thing, but do the thing that will be most comfortable for you in the end to pay that tax and not get slapped with penalties. Just to give you an idea of how much repatriation tax the IRS collected in 2017. Apple, large multinational corporation, had a $38 billion tax charge on their tax return related to repatriation tax. $38 billion. Microsoft, $20 billion. Oracle, $7 billion. Citigroup, the large banking group, $6 billion. Goldman Sachs, investment bankers, $5 billion. Chase Bank, $4 billion. Those are billions of tax that they collected of the repatriation tax. Unfortunately, the large multinational corporations were the target principally of the repatriation tax and the target related to the whole deferral of recognition of the income. The unfortunate part is there was no exemption for small, closely held corporations. Most of our clients are closely held businesses, and there was no exemption for closely held businesses. So whether you were Apple or you were mom and pop with a cut and sew operation in Juarez, both types of entities were subject to the repatriation tax. No doubt, a lot of bad news for closely held businesses.
And one thing that also affected clients differently is it was written in a way that it penalized individual shareholders of foreign corporations, actually had a higher tax rate for individuals than it did corporations. So I joke around with Bill a lot and other accountants and other lawyers. This entire tax reform was written in a way to be beneficial for larger corporations and for corporate structures, and in a little bit of my comments later I'll address why that's the case, because a lot of this law was written for the benefit of corporate owned structures and not for individuals.
Thanks, Josh. The next part of the Tax Reform Act that will have an ongoing impact on the tax costs of doing business internationally is what we come to call the GILTI tax, the Global Intangible Low Tax Income. Now, try and put out of your mind that it has something to do with intangible assets, because it has virtually nothing to do with intangible assets, but euphemistically that's what they called it to make it more palatable as it went its way through the political process. Now, we talked about that timeline of January 1, 2018. Prior to 18 was the repatriation tax, where all of that income that had been deferred for many, many years all of a sudden was recognized for U.S. tax purposes. Now we're talking about from January 1, 2018 going forward. So this GILTI tax wasn't just bad news for 2018, it's the gift that keeps on giving. We'll have to face this tax from now on. It's considered a permanent part of the code. Certainly everything in the code is subject to change based on political whims, but as it's currently written, this is what cross-border structures and international taxation will have to deal with, that being the GILTI tax. What it is, as Josh stated, is that it basically allows for no more deferral of current income. So 2018 going forward, every year on the tax returns of U.S. corporations or U.S. individuals, they'll be reporting related to the recognition of the income of a foreign-controlled corporation. Now, the calculation itself is a work of art. It's amazing what practitioners have had to go through in order to calculate it, first based on the code, which was immediately released, and then the regulations which have trickled out. There have been or will be at least 1,000 pages of regulations that the IRS will have to issue in order to really give clarity and instruction to practitioners and to taxpayers of how to properly apply the law. So tax practitioners and attorneys, we've done our best to apply the law based on the fairly limited guidance that we had, particularly when preparing 2018 tax returns. We have more guidance now for 2019 and going forward. There are no loss carryovers as it relates to GILTI because it is a year-by-year calculation. If your foreign entities had big losses in 1 year and a lot of income in year 2, it doesn't matter. The losses from year 1 do not carry over into year 2. That's how you can get whipsawed with GILTI. So the timing of deductions is critical. Make sure you discuss deductions and things of that nature with your practitioner before the end of the year. So if there's an opportunity to defer some deductions into the next year, when you know that'll be a more profitable year, that's something that ought to be considered. There are deductions and credits that are available in the GILTI tax computation that in given circumstances will reduce the GILTI tax itself to a very minimal amount or zero. The indirect foreign tax credit or the deemed foreign tax credit that's available, and a 50% GILTI deduction that's also available to corporations is invaluable in limiting the cost of doing business, the tax cost of doing business across international boundaries. Now, individuals are a little bit different. As Joshua mentioned, individuals have taken it on the chin as it relates to cross-border transactions. In order for an individual to get that same 50% deduction and that same deemed foreign tax credit, which can reduce the GILTI tax, the individuals have to make special elections. We refer to this, one of these elections as a 962 election. It's something that can be done that will reduce the current tax on these earnings of foreign corporations, but it's not the end all. There may be some other future tax consequences that may be unpleasant, and great care needs to be exercised when making a 962 election. Again, with GILTI, there's no exception for small businesses. GILTI was primarily developed for large corporations, large multinationals, but no exception for individuals. However, there has been in some temporary regulations a bit of relief that is related to what is called the high tax exception or high tax exemption. What that exemption is if you have a foreign entity in a tax jurisdiction whose corporate tax rate is greater than 90% of the U.S. tax rate, then that entity's income will not be subject to GILTI here in the United States. Now let's talk about the practical application for what we're dealing with here on the US-Mexican border. The Mexican tax rate that Paco described is 30%. The US tax rate is 21%. 90% of 21% is roughly 19%. We know that Mexico's tax rate is 30. Ours, the effective tax rate for this exemption is 19. So those who pay Mexican tax of 30% will not be subject to GILTI. That's a bit of a relief as far as a tax liability. However, there's no relief related to the compliance. Those same entities will have to prove out by doing a GILTI calculation and filing all the forms that need to be disclosed in order to qualify for that exemption. When will that exemption be available? It'll be available the year after the regulations go final. The regulations have yet to go final. What does that mean? Again, a practical application. For 2020, GILTI is still in place and the tax liability related to it is still in place for 2020. So on tax returns that we're filing in the spring of 2021, it'll still have GILTI on it and perhaps a GILTI tax liability. But if the regulations are finalized before the end of this year, we may have some tax relief related to tax year 2021. Josh, do you have any other comments about the high tax exemption?
The biggest problem with the high tax exemption, honestly, is the document. A lot of these are very document intensive requirements. It's almost, if anyone's been through a transfer pricing study or anything like that, it's going to take significant documentation to, justify these high tax exemptions. And some of it doesn't always work out. We know that the prevailing rate in Mexico is 30%, but there are some types of transactions in Mexico that can fall under the 19% threshold. So you have to be very, very, very careful when you are going through these calculations that you're just sticking there thinking in your mind, okay, I'm paying a 30% tax rate in Mexico. If that effective rate drops under the 19%, you're still going to be subject to GILTI regardless of whether you can justify it or not. So there's buckets of income that are still going to be taxed in that GILTI calculation. And like Bill said, it hasn't gone final yet. With as many times as they've pulled these regs, I think the first time they published them was in October of 2018, and then they've constantly pulled them and republished them. I'm not 100% sure from a legal perspective that they're actually going to go final this year. I think they are, because I think they finally worked out a lot of the issues that practitioners had with it. So it will be a relief. For the most part, it will give most people on the border that are doing cross-border in Mexico relief. But if you have operations in other countries that fall below that 19% threshold, you have to worry about it. You also need to worry about the fact that that tax actually goes up, I think in 2023. It actually shifts and it goes higher. So that threshold's going to go higher, which technically benefits you, but it also means it, to the extent that you're going to have GILTI, you're going to be paying more of the GILTI tax at that point.
One thing about the GILTI inclusion amount, the amount of the foreign income that's being recognized on U.S. returns, that GILTI inclusion amount has to be calculated under U.S. tax principles, not under Mexican tax principles, using Mexico as an example. So some of the beneficial deductions that are available, for example, in the agricultural industry in Mexico, the use of a net operating loss in Mexico, those types of things can make the tax rate in Mexico go below the 19%. So you may still be subject to GILTI tax just because we have to calculate the GILTI inclusion based on U.S. tax principles. That's why practitioners have been asking for basis of assets that were purchased, fixed assets, so that we can recalculate depreciation according to U.S. tax rules, not according to Mexican tax rules. So there are a lot of wrinkles in the law that we would think at first glance might exempt us from paying the tax, which might not necessarily be the case. The compliance woes that we've had to deal with are significant. The Form 5471 that you may be familiar with, where a U.S. person, whether it be a corporation, a trust, a partnership, an individual has to file to report the existence of an investment in a foreign entity. In the past was a 6 or 7 page disclosure, which was bad enough. Now, I counted up the pages just the other day in preparation for our get-together today. Now it's 23 pages. So it's tripled the amount of disclosure that has to be made by a U.S. taxpayer related to their investment in foreign activities. Imagine if you have more than one foreign entity, but 10 foreign entities. That's 230 additional pages to a typical U.S. income tax return, which is far more complex than what we would have ever imagined even 5 years ago. This is going to require a lot of planning with Mexican CPAs, U.S. CPAs, and U.S. Tax Council to work on structures going forward, the timing of transactions, and working on ways to help avoid or reduce the amount of guilty tax. Unfortunately, in Mexico, because of some of the current and future disclosures related to tax planning that now have to be disclosed to the Hacienda, that makes it even more challenging. But there's still a lot of uncertainty about the law, and certainly we're doing our best to keep you abreast of those changes and make sure that we apply the law the best we can and minimize your cross-border tax liability as best we can as well. Josh.
Like Bill said, and I've said before, this law was not written in a particular way to be beneficial for individuals. Pre-TCJA law, pretty much any tax council accountant would probably tell outbound U.S. people that own businesses in Mexico that the appropriate structure for you to use is a pass-through structure, an SRL that checks the box here in the U.S., mainly because of the fact that it's more tax efficient. That's not really the answer now, and there's a few reasons why that's not always the answer now. Number one, this system created what's called a deemed participation exemption. Lack of a better word, basically allows free flow of profits from any, what we call a controlled foreign corporation, to a 10% U.S. shareholder. That means that you can basically get your money out of Mexico into U.S. corporations without having to pay the withholding tax in Mexico or withholding tax under the U.S. tax treaty and corporate income tax that you normally would have had to pay pre the tax reform to get that money out of Mexico. So there's an opportunity for you to bring operational money back from Mexico through a dividend to the U.S. and not have to pay any tax on it. That's one of the other, kind of hits on the chin that individuals have had, because individuals do not qualify for that. So a lot of things we're seeing now is you have to really do an in-depth analysis of whether or not it's beneficial for you to stay in a pass-through structure or use a corporate structure moving forward. My gut is that corporate structures are going to become more prevalent nowadays because of the actual deferral. That's the only deferral you get, because you can determine when you pay dividend tax when it gets up to the U.S. level. You don't always have to bring that out. You can decide whether you're going to pay it out as wages, you're going to pay it out as normal expenses of the U.S. operating business, or you can determine, I'm going to sit on this for 4 or 5 years and then I'm going to distribute it later. And obviously, with the difference in tax rate between the individual rate and corporate plus dividend, it's not that much anymore. It's about 7%. So the savings that you could have on holding that money back over a 4 or 5 year period may negate the tax savings that you would get through a pass-through. So we're going to see a lot more corporate structures, especially because of the ability to move money back and forth from Mexico to the U.S. and other countries. There's another unique thing that's also beneficial to corporations is not there for individuals. It's what we call FDII, and I can't ever remember the acronym, Foreign Derived Intangible Income. And effectively what that means is, and there's still regs coming out on this, but if you have intellectual property that you have in a U.S.-based business that is utilized in a foreign country, there's 2 tests for it. But If you qualify for those tests, then you can get an actual preferential tax rate on royalties that you pay back to the U.S. company. And it's I think it's 12.375%. So it's kind of what we call earnings stripping. You can take money that you earn in a higher tax jurisdiction, pay the royalties back to the U.S., and you'll have an effective lower tax rate on that money because you'll get the deduction in Mexico or any other foreign country. Whether that continues to exist is it's questionable, because a lot of countries have taken umbrage to the fact that we've offered such a preferential tax rate. They're suing us in the WTO about it, saying it treats Americans, better than other individuals. So as for now, it's there, but it's only available to corporate structures. It's only available to U.S. corporations. As an individual, you don't get the benefit of utilizing that. The test is basically if it's a goods test, like if you produce goods, then as long as those goods are sold outside of the United States, you qualify for it. If those goods come back into the U.S., you don't qualify for the lower tax rate. The interesting part about it is the services test is a lot more beneficial. The services say that if the services are performed outside of the country, the maquila industry is pretty much all service, so it's a very big way that you could potentially utilize it, except for the fact that there's some complications with dealing with it with the IMEX program in Mexico of whether or not they can actually pay royalties out to a foreign entity, because it's supposed to be calculated based on labor cost. So there's some interesting planning opportunities that FDII gives corporate structures, which, like I said, is probably going to push people more and more to thinking about utilizing corporate structures in their outbound transactions moving forward. Bill touched on one thing that I want to briefly comment on. The 962 election for individuals, it's not, as he said, a permanent solution. It's not always the best solution, mainly because it creates a situation where it's kind of a sledgehammer approach to solving this problem. It solves the guilty problem, but it also creates other problems because it deems you to be treated as a corporation for tax purposes for what we call subpart F. There's a lot of other nasty tax consequences that can come with that if you make that election without actually talking to your accountant or your tax advisor. So before you make that 962 election, make sure you talk to them first. My gut is, and I have strongly counseled my clients against making that election, because I've never found the facts to warrant doing that rather than restructuring into a corporate structure. I've had many clients ask me, usually whenever you go through the steps of figuring out which solution is best, the solution is that you restructure them into a corporate structure. That's also now complicated by the fact that all of these things have to be cleared by Mexican Hacienda. You have to basically disclose these tax transactions now and get pre-clearance for them before you go through them. So it's an added layer of complexity that you have to look at when you're doing it. Another question that pops up.
One comment about the 962 election. It's an annual election. So if you make it in 2000, on your 2018 tax return, you're not locked into it necessarily for 2019 going forward. So it may be you bought yourself some time to restructure corporately and do things differently that would afford you the same benefit that the election does.
Yep. And we've done that as a kind of a safe harbor, I will tell you, when we haven't had the time to restructure. Sometimes that takes a while. It's not always easy restructuring in Mexico, as anyone that has experience with using Alex is throwing his hands up in the air, but it takes a long time to restructure things in Mexico. A lot of people ask, okay, well, what about now? What are we supposed to do post-tax reform? What's the best structure? How do we get our existing businesses into compliance? How do we structure best for tax? I wish I had an easy answer for you on this. It's a lot easier going from what we call a pass-through entity, an SRL that checks the box, to a corporate structure. There's a few disclosures that we have to file here in the U.S. There are obviously the restructuring costs in Mexico of converting from an SRL to an SA de CB. but it's easier from a tax perspective. If you're already a pass-through and want to become if you're already a corporation and want to become a pass-through, that's a lot more complicated, because what ends up happening now is not only do you have to deal with what we call a deemed liquidation when you convert a corporation into a pass-through, which basically means you're going to get taxed on your earnings and profits. You also have to deal with the fact that now there's an added GILTI calculation to that whole process. So there's another layer of tax on making that conversion that didn't exist pre-2018. So it's kind of makes people shy away from taking an existing corporate structure and making it a pass-through. So it's almost kind of locking you into your existing structure at the end of the day. Some other things that I think are important for people to know about structuring. I think everyone needs to be very cognizant about this proposal in Mexico about the Mexican estate tax, and there's a reason for it. On the U.S. side, we already have an estate tax. Non-residents are already treated fairly unequally under our system on the estate tax side. They get a $60,000 credit versus our $11 million credit. My concern is that Mexico is going to mirror that, and for U.S. people that own Mexican assets, they're going to penalize them the same way, and we're only going to get a small credit in Mexico for assets that Americans own. The flip side of that is for dual residents, you're going to have to deal with the fact that you have an estate tax over here, and you have to deal with an estate tax over there, and that estate tax is far more. There's a far lower threshold to meet that tax in Mexico than it is here. You get $11 million here, it kicks in at 10 million pesos in Mexico, $500,000. So, it's going to potentially hit people hard. There's no double tax treaty for estate tax between Mexico and the U.S. There's never been a need for one because Mexico doesn't have an estate tax right now. Until that gets negotiated, there's probably not going to be very much tax relief if you have to file estate taxes in two countries. And the other part of the problem with the Mexican tax, as I understand it, is it's provisional, and it's basically you have to pay it up front. It's not a death tax, it's an asset-based tax. It's paid up front the way I understand that they're going to implement it. So there's a mismatch of when it's going to happen. So it's a very, very big problem that I think for a lot of cross-border individuals that have assets moving back and forth and businesses moving back and forth, of something that we need to be aware of. And there's a lot of planning opportunities that we have utilized in the past that I'm concerned that are going to go out the window based on this pre-clearance stuff with Hacienda. So it's just something to be aware of. I think it's going to happen. I agree with Paco. I think it's going to happen either this year or next year. And it's just something that we're just going to have to plan for. It's a lot of uncertainty in this area, and it's just something that we're going to have to deal with. Finally, some of the other things that I think you need to watch out for at the end of the day in terms of this, moving into corporate structures creates some other issues. You have to deal with concerns about whether you have a personal holding company. The accumulated earnings tax is going to come back, which is what happens when you don't distribute, income from an entity that has a lot of earnings and profits. Be aware of PFIC problems. I mean, this new 10% thresholds that they're using for CFCs nowadays is going to create a lot of problems as well. And I think you just need to be aware that this is a really, really complicated landscape. This reform, although on the domestic side was very beneficial for U.S. taxpayers, this is not a very, very beneficial regime for anyone realistically other than corporations, and even then the compliance aspects of it, as Bill addressed, are very, very complicated. To touch base on one last thing and then I'll conclude, 5471s, they used to be an informational return. Now the service is using that to trace and try to find people that are not reporting their income, not reporting their assets. So now they've increased the teeth to it. There's a lot of penalties that deal with it. The biggest thing that I think that happened under the TCJA is they expanded the amount of people that had to file this. The attribution rules changed. So there's a lot of rules now that may make it to where you didn't have to file in the past, but you have to file now, so it's something that you probably should talk to your accountant about, whether you fall into that class. The other thing is that there's these new additional forms that you started to have to file in 2015. It's not part of the TCJA, but you need to be aware of them, 8938s, that if things don't go on a 5471, they're probably going to be on an 8938. Realistically, the only asset, foreign asset, as a U.S. person that you don't have to report anymore is real estate. If you own directly real estate, there's not really a form to catch it. Anything else, if you own a partnership interest that's over $150,000 in Mexico, you're going to have to disclose it on that form. So just because something's not on 5471, if you have any foreign assets, you need to disclose it to your accountants, your lawyers, so they can determine whether or not there's any other forms that is going to catch this. So you make sure that your filing requirements are met, because the penalties, as Bill said, some of these are $10,000 per form. Some of them, if you get into 3520s, which disclose other kinds of assets and other types of gifts, it can be penalized based on a percentage of the gift or a percentage of the asset. So it's a significant penalty. Ready for questions? Okay, I think we're ready for questions.
The repatriation tax is eliminated if you plead guilty? If you paid the repatriation tax in the first year, then it's gone in the second year, correct?
If you paid repatriation tax in 2000 on your 2017 return, that was the catch-up year. That's the toll tax of all of the prior years.
Right.
So guilty is what takes over in place of the repatriation tax in 2018 going forward. So you'll still be subject to guilty tax in its calculation.
No. Sure. One thing I want to say about guilty that gets lost in it and on the deemed repatriation, if you elected to pay over the 8-year period, you're obviously still paying it, but it is a one-time tax. Guilty is intended to continue to go on. One thing that I think that gets lost in the guilty part of it is it is treated as previously taxed income, or what they call PTEP now. So if you get taxed on it in a year, then you distribute the money in a following year, you shouldn't have to pay tax on it. However, it's not that easy because there's ordering rules that we have to go by. So there are some problems with that could end up to where you actually, if you distribute money in a future year, you're going to pay tax on that before you pay tax on the PTEP. So it's not all bad, but the deferral's gone.
So are you suggesting that people that have SRLs, pass-through entities, that they make an 8832 election on those in a corporate structure on the U.S. side?
I think you have to sit down and figure out how much it's going to cost you in the long run and in the short term. Obviously, there's tax savings from going to a pass-through system. I mean, any of us that have practiced in the area of know that the tax rate on a pass-through entity is the difference right now is 7%. So you're going to save 7% of tax over the year. The problem is taking an already existing corporate structure and converting it into a pass-through structure. You have to figure out, A, am I going to pay tax on the deemed liquidation, and how much is that? B, am I going to have a guilty tax computation that I'm going to have to pay? And then you have to judge, okay, are my tax savings over the lifetime of my entity from going to a pass-through, is that going to outweigh having to pay the deemed liquidation up front or the guilty? If you liquidate into another entity, that's different, obviously. If you take an SRL that's directly owned by an individual, that's when the deemed liquidation is going to cause you tax. If you liquidate into an already U.S. corporate parent, i.e. you take an SRL and turn it into a check the box and it's got a corporate parent owner, you're not going to have to pay that deemed liquidation whenever you convert. So I think honestly, Used to, the answer would be is if you're willing to pay the tax up front on the deemed liquidation, go ahead and do it because you're going to save a lot of tax over. The problem is now that the corporate tax rate is much lower than it used to be, than 35%. There's a lot of things in my mind that it's hard for me to justify paying that amount of tax up front just for a savings of 7%. Plus, there's also other issues with going to a pass-through system because, you could be trying to keep your money in Mexico to, operate and everything else, and all that money is going to flow up to your return after that. So I think it's not nearly as easy of an answer anymore. I mean, our used to answer would be, yeah, go pass through because it's a significant tax savings. You're talking a corporate tax level of 35% and a dividend tax of 23.8%. You're paying 55-ish% on your taxes versus 37 or 39 when the rate was 39. It was a no-brainer. I mean, you're saving almost 20% tax at that point. Now you're only saving 7. I don't know if it's the right answer anymore to stay and go as a pass-through.
And we have to be careful on the deemed liquidation as well to not look just at the balance sheet when identifying what the assets are. There could be unbooked intangibles or low basis intangibles on the books whose fair market value when measured could be significantly more than its cost basis. And that would be part of the liquidation.
Well, what I'm hearing is that if you've already got a client that has a structure, for example, let's say he has a U.S. corporation and it owns an SRL that's made pass-through election, that it's easy to go ahead and just file on 8832 to have that SRL taxable as a corporation. Now, I understand if you're SAA that it's more difficult to go to a pass-through entity on the Mexican side. But just kind of looking at overview, it's better now to have the individual U.S. person own the U.S. corporation, which owns 100% of the SRL taxable as a corporation, and then peel the onion. That's the better structure.
In concept, yes, but you have to do some projections and do some planning to know really how in that particular circumstance your profits, what they will look like in the future, and what you plan on your distributions being.
One of the problems with that and projecting is if you have big swings like Bill was talking about, if you have significant losses one year and high profits the next year because of the way GILTI works, that might not be a great structure for you because you can't net year to year because it's calculated on a year basis. So if you have big swings, that might not be. That's why this is really subjective in trying to determine whether or not this is the right structure for you. There's no golden rule anymore about, okay, this is the exact way, because used to when I first started doing this, it was real easy. You would go to a pass-through structure unless there was a reason why you needed to block income off. Now that you can't defer that income and now you have this calculation based on a year, you have to really dig into what the business is doing and figure out historically what it does to determine what the right structure is.
Do you know yet, let's assume that the estate tax is enacted in Mexico, do you know whether an individual, U.S. individual owning stock in a Mexican corporation making a 962 election will avoid estate tax in Mexico?
The proposal in Mexico so far has been very bare bones on detail. I'm not sure if we know yet whether it's going to follow normal Mexican conventions and it's going to be based on residency, or if they're going to implement a system like we have, where it's based on nationality.
Do you have time for one more? One more.
Under the tax, under the state tax, as far as we understand, I'm sorry, I got myself a little allergy and it cost me to do it. Anyway, as it stands, it'll tax assets in Mexico, regardless of nationality. One thing is, if it's a U.S. citizen who lives in the United States and has assets in Mexico, according to the state system and the probate system in the United States. The U.S. judge would not adjudicate anything, and you'd have to go through a Mexican judge to get this thing adjudicated. So that's where you got the payment coming. Now, as to the provisional payment that you talked about, this means as far as current tax legislation in relation to provisional payments, this means that the estate will pay this tax through whatever authorities are designated, and this will be taken as a provisional payment. The heirs at the end of the tax year will make their annual return and accumulate this inheritance, calculate the final tax, give themselves a credit on what they paid for the inheritance tax, and pay the difference. This could very possibly, very easily get them up to the 35% bracket. So 10% and 20% is so much hogwash. I think it's going to be 35% in the end.
All right. Well, I think that that about does it. We're out of time. They're about to kick us out. But thank you all for coming. We really appreciate your attendance here. I know that was a lot of information. I think we definitely conveyed the complexity of international tax, along with hopefully conveyed the seriousness of making sure it's done right. If you have any questions, any further questions, please feel free to get in contact with any of us. And hope everyone has a great rest of the week. Thank you.